Hi, everyone. Thanks for joining us today. We are really excited to have you all here. We have Matt Reardon here from Goodwin to talk about VC terminology, key terms. So Matt is in the Life Sciences and Technology group at Goodwin, and he's also a business and securities lawyer. So with that, I will turn it over to Matt to get us started. Thanks, Matt.
Great. Thank you very much for that introduction, Emily. And as Emily mentioned, my name is Matt Reardon. I'm a partner in the Tech and Life Sciences group at Goodwin. I'm joined by my colleague, Wen, who is also in the Tech and Life Sciences group at Goodwin. And we work with early stage companies, later stage companies, investors, founders, universities, everyone who's in the kind of tech and life sciences innovation ecosystem. And the workshop we have today is on understanding the key terms in venture capital financing. So a few weeks ago, we gave a presentation on key things to think about when forming your new business. And then this is the next stage, which is things to think about when you're financing that business that you created. So the first thing, I'll just quickly run through the agenda we have to the topics we'll cover. First, we'll talk about the initial capital infusion into your company, and specifically the difference between a SAFE, a convertible note, and preferred stock, which are the three most common forms for financing early stage companies. Then we'll talk about documenting specifically a preferred stock financing, and then specifically the economic terms of a preferred stock financing, the investor control and governance terms of preferred stock financing, and then some of the other key terms. For anyone who has participated in our last workshop, I think we'll do the same format here since we're all online, which is we'll cover a slide and then we'll take a little pause at the end of the slide to answer any questions, have discussion, then we'll move on. And then at the end of the full presentation, we'll reserve a bit of time for any remaining questions. So the first thing to talk about here are convertible notes and safes. So convertible notes and safes are the dominant forms of seed financing for early stage companies. Until about maybe 5 years ago, convertible note was just the dominant form. Now it's really become safes are the almost ubiquitous form of financing early stage companies. The first round of financing they get, their true seed, most commonly these days is done through a SAFE. So we'll cover SAFEs next, but just to give you a description of what a convertible note is, because you still do see these, and a SAFE has the same general concepts as a convertible note. Is convertible notes are a loan, a debt instrument that ultimately convert into preferred stock when a company raises a preferred stock financing. So the idea is that a company can issue a convertible note as a way to defer the negotiations around a company's valuation, all of the terms of preferred stock, all the investor economic terms and governance terms that come along with preferred stock. Instead, it's a short-term loan that can be documented without nearly as much negotiation as preferred stock that will convert into preferred stock in the future. The key economic issues of convertible notes are the valuation cap, which is not a necessary feature, but is a common feature. And it's kind of the highest valuation of a company that the convertible note will ultimately, convert into the company at, and then potential discount rate. So a flat rate of that the convertible note will convert into the preferred stock at a lower rate than the person who's buying new preferred stock. So maybe that's a 90% rate. So you get the investor would be buying that preferred stock for 10% less. Convertible notes can have a wide number of other provisions in there. There's no standard form of convertible note across the industry, and it is a debt instrument. So you can see all types of things in there, like a maturity date, by which if the note hasn't converted, the company has to pay the investor back. A exit multiple, so if the company did a sale of the company before the note converted, that note might get 2x what the person invested, the investor invested. It could include operating covenants or negative covenants the same way that you'd see in like a bank loan. It typically includes like relatively extensive representations and warranties given by the company that's issuing the note. So because of all those kind of like potential complexity factors, the SAFE, which we'll get to next, which is significantly more streamlined and simple, has become more common for early stage financings. Convertible notes you still see pretty frequently for a bridge in between a company's preferred stock financings. It becomes particularly useful for investors if the company issuing the note has actual assets that would be available to a creditor if there is a wind down of the company. So the fact that it's debt, if the company, when it, if we were to wind down, wouldn't have assets that it would be available to a creditor, then having a debt relationship for the investor isn't as valuable. And one thing I mentioned is that typically convertible notes have a maturity date by which they have to be, if they don't convert, the company will owe them the money back. It's very uncommon for an early stage company to actually have money to repay an investor. And so what most commonly happens is if you get close to that maturity date when the note has to be paid back, it just gives that investor leverage to come back to the company and say, I know you don't have the money to repay me, so now we need to rework this deal in a way that's even more beneficial to me. So that maturity date gives the convertible note investor leverage over the company that doesn't exist in a SAFE, which I'll get to next. So before I move on to the next slide about SAFEs, I'll pause for questions. Okay. So a SAFE has the same general idea as a convertible note, which is that an investor buys a SAFE, they invest money into the company, and they just get an agreement that says, when this company raises a preferred stock round in the future, this SAFE will turn into that preferred stock. And that can be super valuable to both companies and investors because it allows you to negotiate that investment much more quickly. The idea is that sometime in the future, a lead investor who's willing to lead a full negotiation of a preferred stock round will come in. But until then, the investor and the company issuing the SAFE don't have to negotiate most of those terms. And so the word SAFE stands for Simple Agreement for Future Equity. They're a contractual alternative to convertible notes. So there's no debtor-creditor relationship. It's just a contractual relationship between two parties. The SAFE can include a valuation cap and a discount rate the same way that a convertible note can. There is a standard form of SAFE. Y Combinator developed it, and it's available to the public on Y Combinator's website. And usually people use the SAFE by just like downloading the form and modifying it a tiny bit. So the amount of unique terms, the amount of negotiation, the amount of customization for a SAFE versus a convertible note is usually just much less. A SAFE provides investors with comparatively fewer protections than a convertible note, and really no governance rights over the company. And so it's become the form of just very quick, simple, inexpensive financing for startup companies. The one thing I'll say about safes is it's pretty common for companies to issue them kind of iteratively on a rolling basis. So early stage company can issue safes and then find a new investor, issue more safes. And so what investors often want to see is what's called a most favored nations clause, because they know that an early stage company might go out and raise more safes in the future. That most favored nation clause says that if the early stage company goes out and sells more safes and sells them on better terms than they sold them to their initial investor, that the initial investor's safe will automatically adjust to be just as favorable as those later investors. So before we move on to kind of preferred stock, I'll take a break to see if people have questions about convertible note safes, the difference between them. This is convertible note or safe is likely what you'll see people propose as a financing mechanism early on, shortly after you've formed your company. So it's the most likely form of financing that you would see.
We did have a question from Ruben in the chat. Ruben, I don't know if you want to come off mute, otherwise I can read it.
Yeah, sure. The question is just, are there any typical ways in which interest rates are determined for the convertible notes? Or is it like a flat rate always? I don't know.
Yeah, that's a great question. So interest rates on convertible notes, they don't, like, the market doesn't shift too frequently. So for a very long time, people were they were pretty much usually 4% or 5%. And since interest rates have gone up over the past year, now you see most convertible notes have an interest rate of like 8%. It's ballpark, but you don't see a lot of fluctuations or shifts in the market. It's like usually it used to be 4 or 5, and now it's 8 or 9 or 7. It's pretty standard. And for discount rates, you see, I would say most safes and convertible notes have a discount rate between 80 and 90% of full price. So they either get a 10 to 20% discount. You see outliers. You could see a 25% discount or a 5% discount, but in between 10 and 20% discount rate is kind of the market.
Awesome, thank you.
So this chart just shows a super high level overview of some of the key differences between safes, convertible notes, and preferred equity. So for the safe and convertible note, you can issue a safe or convertible note without negotiating the company's valuation. For a preferred stock, there has to be a set valuation of the company. Safes and convertible notes typically have very minimal investor governance rights. Preferred stock typically comes with a long list of negotiated rights of the investors. The safe and equity don't create a creditor-debtor relationship. Convertible note does. Phantom liquidation preference, I didn't mention this before. So because the safe and the convertible note typically convert into preferred stock at a discount, either based on a valuation cap or based on just a flat discount rate, they're paying less for the same equity that investors pay for. Preferred stock has what's called a liquidation preference. And that is basically the amount that that investor, that stockholder, has to get paid back before the common stockholders will get any proceeds from the company, any distributions from the company. So a preferred stock investor's liquidation preference is typically set at the amount of money they put into the company. If you are an investor with a SAFE or a convertible note that converts into preferred stock at a discount, if you get the same liquidation preference as the investors that pay full price for their shares, you're essentially getting, when the company makes distribution, money for free. You're getting a liquidation preference that's higher than the amount of dollars you actually put into the company. We call that a phantom liquidation preference. Safes typically don't get that. So safes usually convert into a type of preferred stock that looks exactly the same as the other preferred stock that people are paying full price for, other than it has a lower liquidation preference that's tied to how much money that investor actually put into the company. Convertible notes typically get that phantom liquidation preference. So what does that mean? It's just another thing that makes a convertible note just generally more favorable to the investor than the company, and more favorable to the investor than a SAFE would be. And then when we talk about how much it typically costs the company and the investors to actually negotiate these documents, I would say SAFE, typically the least expensive, then convertible note is more complicated, has more terms that are bespoke, takes more money to negotiate, and then preferred stock equity is typically the most expensive, most time-consuming process. So I'll pause if there are any questions.
I did get a message from someone that cannot unmute right now. Are any of these early funding options more friendly to a founder who might not take the classic VC financing route in the future? So, for example, someone's still considering bootstrapping or angel type options, or are all three locking you into a more classic VC financing route?
It's a great question. And so I think that none of these are locking you, the SAFE and the convertible note aren't locking you into a traditional VC route. They do kind of assume that you're going to sell preferred stock in the future. And so that means they carry the assumption that you are going to take money from investors in the future who are going to have a type of stock that's different than the founders. And so they're not locking you into a VC route, but they assume that you'll raise money from an investor in the future. For companies that are thinking of raising less capital on more founder favorable terms, etc., the SAFE would be the most common approach. It builds in the fewest expectations about what the company will look like in the future. And it builds in the fewest expectations around the amount of control that the investors will have over the company in the future. Okay, so we just covered SAFEs and convertible notes, which both assume a conversion into preferred stock in the future. Those two types of financing typically documented with either a SAFE or an actual convertible note document, not a lot of documentation. Preferred stock investments typically have significantly more documentation, and we're not going to go into all of these documents. I've just listed them here to show you the different key documents that would get negotiated as part of a preferred stock financing. So the first document would be the term sheet, which basically lays out the key points of a deal. So the typical process would be, once an early stage company and an investor have gotten to a loose agreement that the investor is going to invest in the the investor would prepare a term sheet, which lays out the key terms of their investment and deliver it to the company. Typically, the terms of a term sheet are all non-binding, other than a confidentiality provision and an exclusivity provision that would prevent the early stage company, the company that's raising money, from talking with other investors for a period of time. Usually that period of time is like 30 to 60 days. Usually everything else in the term sheet will be non-binding. It's just kind of the rules of the road for how the parties are going to negotiate the key documents. And those key documents are a charter, which is like the document that has the rules that govern the stock itself, and that gets filed with Delaware. It gets filed with the state, it's publicly available. And then a stock purchase agreement under which the investors actually buy their shares, an investor rights agreement, which lays out a host of rights that the investors have with respect to the governance of the company, a right of first refusal and co-sale agreement, which essentially puts restrictions on the ability of the common stockholders, including the founders, to transfer their shares out of the company, a voting agreement, which is an agreement amongst all the stockholders on how they'll vote their shares on key company issues, and then side letters. So a lot of investors have their own kind of specific to them terms that they like to put into their transaction documents. All of the documents that I have listed up on the screen here, other than side letters, do have a standard form that's used in the industry that's publicly available online. They're published by the National Venture Capital Association. You can find these documents at nvca.org. And they are not used in 100% of venture capital financings, but they're used in the vast majority. And they form the basis for the terms that are used in deals that don't use the NVCA forms, but most deals are on these forms, and they make the transaction such that there's a lot of terms in those forms that people don't negotiate. So they narrow down the number of items that have to be negotiated with the parties in order to close a preferred stock financing. And I think before I move on, there was a question that I saw flash across the screen.
Yeah, I think Grace is in transit, but she asked, do early stage startups typically work with lawyers for SAFE, or since it's pretty standardized, would investors be providing support there too?
So lots of companies issue safes without working with an attorney. What I would say is the most common kind of progression here is you'd work with an attorney to form the company and get it all set up with, founder equity, all of the governing documents, etc. And then the safe kind of flows out of that. So once you have your company's formation documents done, you have a board created, the board has authorized the company to take actions. At that point, the negotiation that an attorney would help you with on the safe will be pretty limited usually. There's not too many terms that are negotiated. Much of what the attorney will help you with is making sure that everything works with your existing documents, negotiate a few key terms, and then make sure that the company that you're running has properly authorized the sale, that you have your capitalization table set up so that the notes will convert correctly. So that was a long-winded way of saying companies often do issue safes without involving an attorney. If you do involve an attorney with issuing your safes, they'll certainly have value add, and it's typically a pretty, if you've already been working with someone who helped you set up your company, the safe element of their advice to you is going to be incrementally pretty minimal additional work for the attorney. So the first document I talked about on that list was the term sheet. And so if you've formed your company, you're speaking with outside investors to finance your company, your initial preferred stock round, the key things in the term sheet are going to be the economic terms of the investment and the investor governance and control rights they have of the company. We'll talk about the economic terms first. The top line economic term, the biggest one is the valuation of the company. And so you often hear people talking about the pre-money valuation of the company, the post-money valuation of the company. The difference between pre-money valuation and post-money valuation is just post-money valuation is the pre-money valuation plus whatever money the investors put in. So if an investor says, I'll make an investment into your company, I'm going to give you $10 million and I'm valuing your company at $50 million, your pre-money valuation would be $50 million. Post-money valuation would be $60 million. And when you are thinking the pre-money valuation, the importance of that to your legal documentation is it determines the price per share that investors will spend to buy their preferred stock in your company. And so the valuation directly influences how much of the company the investor is purchasing, what percentage of the company. And so when we think about the pre-money valuation and the price per share that investors are going to pay and the percentage of the company they'll ultimately buy, the other key input here is the number of shares of your company outstanding that are being considered part of your pre-money capitalization. And here, there's the obvious, like any stock that exists. So all the stock that you and your co-founders own would be included in the pre-money valuation. But then there's things that aren't so cut and dried as to whether they would be considered part of your pre-money capitalization. Things like the option pool. So if you have an option pool, but you haven't issued all of those options, and there's a portion of the pool that's sitting there unused, that will be a negotiation as to whether that's included in the pre-money capitalization of your company. If the VC is asking you to increase the size of your incentive pool, there'll be a negotiation over whether the increase to the size of your incentive pool will be included in the pre-money valuation or the post. From the investor's perspective, they want to put as much of your company's capitalization into the pre-money as possible. Because once they put their money in, anything that's considered post-money capitalization dilutes the investor. So if you were to say, increase the option pool immediately after they invested, that would dilute their ownership of the company immediately after they invested. So typically they'll say, we want you to have, let's say, a certain percentage of your company that is devoted to an option pool that's available for you to issue to incentivize employees. And investors will typically want that to all be included in the pre-money capitalization of the company, even if it's an increase you're doing for that round. The other thing is that typically convertible notes and safes typically convert into the pre-money capitalization of the company. Again, that's a negotiation between the founders, the safe holders and note holders, and the new investors. But the most common approach is for that to convert all into pre-money capitalization, because again, anything that would convert into post-money capitalization would dilute your new money investors. one question we frequently get is how are we supposed to determine what the pre-money valuation of my company is? VCs value companies all the time. So they have tons and tons of reps doing this. Whereas a founder, if this is their first company, they've never had this negotiation before. And even if they're a serial founder, they may have had this negotiation a handful of times before, but probably not as many times as the people on the other side of the table who this is what they do day in and day out. And there's really no science to this. Early stage companies are typically valued based on not revenue or anything like that, because frequently they don't have revenue, typically valued based on kind of comparable companies to them, the founder team and the idea. And it's more of an art than a science. And we find the best way to find out what the most appropriate valuation for your company might be is to do the research and look at comps, but then also, to the extent possible, get more than one investor who's interested and see what different investors are offering. So before I move on to the next slide, I'll take a quick pause for any questions on this slide. So continuing the discussion of the economic terms of the term sheet. So we talked about valuation. The next piece is liquidation preference. And before I mentioned that a liquidation preference is the amount of cash that a share of preferred stock has to receive before any common stock of the company gets distributions. To drill down on that a bit, there's two different types of how you can look at preferred stock, whether it is participating or not participating. What participating preferred stock means is that the preferred stock gets back their liquidation preference first. So if that stockholder, that investor put in $100, they get back $100 before any common stock gets paid. And then if it's participating preferred stock, once the common stock starts getting paid, the preferred stock gets paid from the first dollar along with the common stock. So we call it participating because the preferred stockholders get paid back first, and then they also participate in distributions of everything that goes out to all the other stockholders at the same level as those other stockholders. Non-participating preferred stock means that the preferred stockholder gets paid back either their preference on the shares, or they get treated as a common stockholder. So they don't double dip. They just get put, if it would be better for them to get paid back their liquidation preference, they get paid back their liquidation preference. And if it would be better for them to be treated as a common stockholder, they get treated as a common stockholder. Participating preferred stock is pretty rare. You usually see it get put in place in subsequent financings of a company if that company is having a difficult time raising money. The issue with participating preferred stock is once a company raises one round of participating preferred stock, for the most part, every future round of financing you do. So if you had participating preferred stock in your Series B round, most likely when you do your Series C, it's going to be participating preferred. Your D will be participating preferred, and so on. As you stack on those participating preferred stock, the preference stack, we call it, that has to get repaid before common stock gets paid anything, and then will participate with the common stock, kind of just builds over time. And so it can really cut into what the common stockholders will receive on an exit event, common stockholders being the founders and all of the employees who got stock options. Much more common to see non-participating preferred stock. And so if you get a term sheet and you're looking at it and it has a participating preferred stock feature, that's one place where should be a red flag. That over time can significantly reduce the proceeds that the founders and other employees will receive. And you typically only see it for companies that are in a situation where they're having a difficult time raising funds. The next point, dividends, another economic point. A dividend is just accruing payment on preferred stock. So a dividend is like an interest rate. If a share of preferred stock has a dividend of 5% year over year, each year, it accrues a 5% extra cash that needs to be distributed out to the stockholder. The most common approach here for early stage companies raising money from VCs is for any dividends that exist to be pretty illusory, in that you'll usually see something that says this dividend has to be paid if the board declares it, and it's non-cumulative. So it doesn't kind of grow year over year. It just grows within a year, and then it sets back to zero, grows within a year, sets back to zero. And unless the board actually declares it, it never gets paid. And in that case, the board of these venture-backed companies almost never declare these dividends, and so it's essentially not a dividend. What you sometimes see more in late stage financings, or again, for companies that are having a hard time raising, might be a real dividend, like a dividend that actually accrues on the shares and has to be paid out. Again, that should be a big red flag because it's pretty uncommon to see that. And so if you see dividends in a term sheet, definitely ask your attorney to explain to you what they mean, because there's innocuous dividends, and then there's dividends that could have a huge impact on the amount of proceeds that the founders and employees get upon a sale of the company. Because like liquidation preference, if you put in place the real dividends that investors have to get paid out, very uncommon for investors to get anything less favorable to them in future rounds. That sets the precedent for what the least favorable thing that an investor would get in a future round. The next point I have here is on vesting for founders and employees. So typically founder stock is subject to vesting over time. And typically the vesting is put on founder shares when they form a company, and on employees' stock options or shares when they join a company. VCs, investors, etc., like to see shares subject to vesting because they give the person whose shares are subject to vesting an incentive to keep working for the company. If a founder's shares have significantly vested at the time of a financing, VCs will sometimes require that the founders revest or reset a portion of their vesting so that they have a longer time until their shares are fully vested. This is again a point you'll want to discuss with your attorneys if you see in the term sheet. It's not ubiquitous across. It's not like you're always going to get this request from VCs. And if you do, the most common approach is to kind of give founders credit for when they really started building the business. So if there was a period of time between when your vesting started and when the real hard work of building the company started, you may strike a compromise where you're getting credit for like when you really started digging in. And so it's fact-based, and you'll want to be able to make your best argument, but this is something you should expect to potentially see when you're negotiating a term sheet. Then anti-dilution rights basically are a provision that says if a preferred stock investor buys shares of the company for a certain price, and then the company has to sell shares in the future for a lower price in what you think of as a down round, the investors who were already in the company their ownership of the company gets adjusted such that it's as if they had paid a lower price for their shares. So it is what it sounds like. It protects the investors from being diluted by a future issuance of shares at a lower price. And redemption rights, just really quickly. This is a concept similar to how I was talking about the maturity date on a convertible note, which is the date by which, if the note hasn't converted, you have to pay back the investors. Redemption rights are a date by which, if the company hasn't been sold or gone public or had some type of liquidity event for the investors, the investor can ask the company to repurchase those shares. And again, it's uncommon for a company to have enough money on its balance sheet to just pay back its investors. And so redemption rights are very infrequently actually used, but they can be used as leverage for the investor to come back to the company and negotiate better terms. So before I move on to the next slide, I'll take a pause for any questions. So this slide is some key governance provisions that investors will negotiate for in term sheets. The last slide was economics. Here's control. So a key point of control is the company's board of directors. Oh yeah, and I do see a question here. So acceleration of vesting is, vesting, the acceleration of vesting schedule upon an exit of the company, which means unvested shares would vest. And the two key types of acceleration you'll see are what's called single trigger acceleration, which means if the company is sold or goes public, all the shares accelerate. The other type of acceleration you might see is called double trigger. That's really only applicable in a sale transaction. And that is, if there's a sale transaction and then the person holding those shares is fired within a certain amount of time after the closing of that sale of the company, then all of their shares vest. That's the double trigger. So single trigger is just all that has to happen is there's a sale of the company. Double trigger is sale of the company and the person is fired. Any type of acceleration, you typically only see that with founders. It's not typical to see acceleration for people who aren't the founders. So if, as you're hiring people and issuing stock options, be very uncommon for those stock options to have acceleration, but not unheard of. Really depends on the negotiating power of the person who's being issued those shares or those options. One thing to think about when you're issuing stock options is, once you start issuing stock options to people that do have acceleration feature, it can be difficult to then issue stock options to other employees without the acceleration feature. So founders frequently try to limit who will have acceleration, because at the end of the day, there will be, when the company is sold, there's an exit event, a pie. There is a limited amount of funds to distribute, and the more people who have acceleration, the more people who will be sharing in those distributions. And so, say if you have if you have someone who's been at the company for 4 years and who vested, and then you have someone who's been at the company for 1 month, if that person who has been at the company for 1 month has full acceleration, they'll be participating at the same level as someone who's been there for 4 years, which, it doesn't really align incentives. So companies typically try to limit who has acceleration of their vesting schedule. So on the control, aspect, the board of directors ultimately is the governing body that makes the key decisions about a company. And a preferred stock investor frequently will ask to have representation on the board. Very common setup for a company raising its first round of preferred stock would be, a board with 3 people, 1 or 2 of which are founders, 1 of which is an investor, and then if that third spot wasn't taken by a founder, then maybe someone who is independent of the company, so not affiliated with the founder or the investors. And typically you'll see that the CEO, who's often the founder, is on the board. So a very common board after a company's first preferred stock financing would be the main founder sitting on the board as a CEO. If there's a co-founder, that co-founder may be the second board member, and then a preferred stock investor. Or maybe instead of a co-founder, you have an independent, and none of this is set in stone. So you have companies that get financed and it continues to be only founders on the board. Sometimes you could have a company that's financed and it would be 1 founder and 2 directors who are appointed by the investors. It's all subject to negotiation, but there are kind of standard benchmarks. What you'll often see in terms of an investor who's maybe not your lead investor may want to have some involvement on the board, but you may not want them to be a board member. There may not be space on the board for them. They may not be putting enough money into the company to warrant having some level of control over it on the board. And so you often see investors that either have a board member who don't have something called a board observer. And a board observer is not a director. They get to go to director meetings, but they don't get to vote on anything. And another big difference between an investor and an observer and a director is that observers have no fiduciary duties to the company. So directors have to act in the best interest of the company. They have an obligation not to, use or disclose confidential information. Observers don't have any of those obligations. And so to the extent that you are a founder and you are agreeing to board observers, keep in mind that although you have to give them the same information as directors and they're going to sit in a meeting and kind of look like a director, they don't have any of the duties that go along with being a director. And so I look at best practice as if you're bringing on a board observer, make sure that they sign an NDA, which a director wouldn't have to sign, and make sure that you're able to exclude them from particularly sensitive parts of a board meeting. So if the board is going to talk about something that you would want to have be truly confidential because it's a trade secret, or that you'd want to have be privileged conversation between you and your attorney, make sure that the contract you have that gives an investor an observer right says that you can exclude that observer from meetings if you need to. So that covers the board. Investors will frequently ask for what's called protective provisions. These are rights where the company can't do certain things without getting a vote of the stockholders. And the key difference here between having to, as a company, get approval of the board versus approval of the stockholders is that, as I mentioned before, the board members have an obligation to act in the best interests of the company. So even though members of your board may be representatives of investors or VCs, they have to vote and act in the best interests of the company as a whole. They can't be making decisions just based on what's best for their investment fund. stockholders don't have the same obligation. And so whereas an investor with a director who is representing an investor on the board may find themselves having an obligation to approve something, the stockholders may not. So a stockholder can act totally in its best interests. And so what we think of as protective provisions are rights that the stockholders have to block the company from doing things without their consent. Those are typically things that go to the value of the shares that they purchase. So things like raising another equity financing, selling the company, changing the terms of the preferred stock that the investors purchased, changing the size of the board, repurchasing shares from the company. All of those things often require the company to get a vote of the preferred stockholders in order to take that action. The list of those things that will be included in protective provisions is often heavily negotiated in a term sheet. When you see that in a term sheet, you should be thinking of all of these protective provisions restrict the flexibility of the company to take action in the future. So you should be certainly working with your attorney to negotiate those in a way that allows you the flexibility to do what you plan to do in the future. So before I move on to the next slide, I'll pause for any questions on this slide.
Amin, do you want to ask your question?
Yes. So basically, if I'm looking for another board member other than founders and investors, who should I look for?
It's a great question. So what you'll frequently see is the founders and investors will often agree. The third investor or the fifth investor, director, whatever that independent director will often be someone in the industry who's unaffiliated with the director and the founder. So someone who's an expert in the business that the company operates in. And the director seats are a limited resource, like the company's cash and equity, limited amount of those seats you can give out. And so finding someone who can really provide value to the company, either based on experience, based on connections, based on their ability to mentor the founder team and help direct decisions, is key. But the most common type of independent director would be someone who is well established in the field. So what you'll often see as an independent director would be perhaps somebody in a similar industry as your company, who was a founder in the past and maybe sold their company and has had a successful exit in your industry or multiple successful exits in your industry. Or if you are kind of like a research-based company, someone who is very prominent and well-respected in the field.
And a follow-up question, do we need to issue them stocks?
So another great question. Early stage independent directors, at really early stage, your question is very targeted in a very good way, which is extremely uncommon for them to get paid in any cash. So most early stage companies won't be giving an independent director cash. Some will give independent directors a very small portion of the company's equity. And it's common to see independent directors with no equity compensation, and then something like 0.1% of the company is also pretty common to see. So somewhere in between like 0 and 0.1 is pretty common for a really early stage company. And frequently that equity that a director will get will also be subject to vesting. Now, it's almost always single trigger vesting because there's no real need for the company to retain the board after a sale of the company. So typically, if you give a director equity, it'll be subject to vesting, single trigger. And instead of 4 years, it's often like 2 or 3 years.
Thank you.
And then for some other control governance provisions here, a drag along. So a drag along is a provision that says if a requisite number, like if requisite directors and stockholders approve a sale of the company, everyone else has to go along with it. So the idea is if the people who have the right to trigger the drag along want to sell the company, they can force everyone else to sell their shares to participate in the sale of the company. A very standard formulation of this is that it requires approval of the board, a majority vote of the founders, and a majority vote of the investors. That is all subject to negotiation, but as you're negotiating this, you want to think of this as under what conditions can you be forced to sell your company? And you may think of yourself, you could think of it the other way, which is under what circumstances should I be able to force everyone else to sell the company? Because as a founder, if you have people who hold stock but are no longer really involved with the company, you may want the ability to make them help you sell the company. And then, so drag along applies to forcing people to do a sale of the company. Mandatory conversion is something that you use to do an IPO. And it's basically a tool that the founders of the company would want to use in order to be able to go public, which is in order to go public, you really have to just have common stock of your company. And so you need a way to turn all of the outstanding preferred stock of the company into common stock. And so investors will want they'll want to have control over when you can convert them into common stock. And as founder, you'll want to have the ability to convert them into common stock. So the negotiation on this point is under what conditions can the company convert all of the investors' preferred stock into common stock such that you can go public. The usual thresholds are if you're going to do a IPO that's going to raise a certain amount of money and that's going to return a certain multiple on investment to the investors. And I'll pause before we go on to the next slide for any questions. Then the other few things that you'll probably see in a term sheet are potentially reps of the founders. And if you see this in a term sheet, you should definitely push back on it. It is very uncommon for the founders of the company to give any reps and warranties with respect to the company. That's what the company will do instead. And if for people who participated in the last workshop we did, one of the things we talked about is one of the real benefits of forming a company is that the company is conducting business rather than the stockholders and founders. And so it's a layer of insulation between any claims against the company and the stockholders. Same idea with the founders reps. The company, rather than the founders, should be making all the statements about the company. Information rights are things that the investors frequently ask for so that they can review a company's financials, its cap table, etc. And so most investors are going to require information rights, and it's just a question of the extent to which they have the right to ask the company for information, and that's something that you'll negotiate with the help of your attorneys. Registration rights are something that founders, we typically say, don't have to think about too hard at the early stages of raising financing. Registration rights are the rights of investors in a company to have their shares registered after a company goes public so that they can sell their shares. And so usually when you're founding a company and negotiating your first financing, that IPO event is so far in the future that it's just not really worth it to fight over the terms very much. Once you get close to an IPO and you get the type of investors who invest in companies that are about to go public, they'll typically have very strong opinions on what those provisions look like and will push to have them amended anyway. So we typically just try to use the provisions that are already in the NVCA terms in the form documents pretty closely, because it's not worth the time and money to negotiate these provisions that are in an early stage. And then the last point on the slide is pro rata rights. And this is the right of your preferred stock investors to participate in any future financings you do. So this is if you have, when you raise a Series seed financing, those investors that you bring in will have the right to purchase shares in your Series A financing. The idea behind this is that the early stage investors want the ability to continue to maintain their position in your company such that not every financing you do is dilutive to them. Now, typically not every investor gets pro rata rights. Typically, you'll limit it to just your investors who are making the largest investment, and frequently it'll be like your lead investor in each round of financing you do. And again, this is all open to negotiation. So limiting the parties that have preemptive rights when you negotiate your term sheet will give you as a founder more flexibility to structure future financings in the way that you want to do that. So before I move on from this slide, I'll take a pause for any questions. And then this is our last slide. And so the last few key terms that you might see in a preferred stock term sheet are right of first refusal on co-sale rights. So this is one of the things I mentioned earlier. Typically, when preferred stock investors come into a company, they require all of the existing common stockholders to sign up to restrictions on the common stockholders' ability to transfer their shares. And the idea behind this is typically investors don't want the common stockholders to be able to get paid for their shares before the investors do. And they also want the founders and the employees of the company to be holding stock so that they're incentivized to participate, like to build the value of the company. So typically, as part of a preferred stock investment, all of the common stockholders will have to sign on to an agreement that says, before I can transfer my shares, I have to offer them to the company first and then to the investors. In practice, this makes it pretty difficult for a common stockholder to transfer shares without the approval of the preferred stockholders. As part of the term sheet, it'll typically say that the stock purchase agreement under which the investors are going to purchase their shares will have a set of representations and warranties that the company is making. So basically, the company is making statements about its operations that have to be true. So things like, this company was validly formed, I'm paying all my employees, this is what my cap table looks like, there's no litigation outstanding, statements that the company makes to its investors. Closing conditions are just things that the company will have to do before the preferred stock investor will invest. A pay-to-play provision, I don't think we need to focus on this because we're running a little bit short on time. And then the last point here is that term sheets, as I mentioned before, are typically non-binding. So they're just like agreements between the founder and the investor that are intended to make negotiation of the documents much more streamlined. And it's considered poor form and can really break down the relationship between the parties and can jeopardize a closing if people try to deviate from the term sheet, but it's not binding typically. Typically, the provisions that are binding, as I mentioned, are the confidentiality provisions, an exclusivity provision, which prevents the company from talking with other investors for a period of time. And sometimes there'll be a binding provision about the investor's legal fees. Usually, the term sheet will say how much the company will have to reimburse the lead investor for their legal fees, but that will typically be a non-binding provision, meaning that if you never close the deal, the company wouldn't have to pay that. The company would only pay that once the deal actually closes. Sometimes you'll see that they're binding so that even if the company didn't close the deal, they'd have to pay the legal fees. I'll say, as a founder, you can almost always negotiate for that provision not to be binding. So make sure you keep an eye out for that and just make it non-binding, because you'll generally win that argument, and it's just something investor might put in there hoping you miss it. And then the point I'll say about confidentiality, or about the no shop, is that given that it's typically one of the only binding terms in a term sheet, and given that it only restricts the company, it only restricts the founder, not the investor, the kind of, as a founder, you should look at the main concession I'm making in the term sheet is this no shop provision. I want to get as much detail in this term sheet as possible so that before I sign on to a binding exclusivity period, I know what all the terms of this term sheet of this investment are going to be. So a lot of times an investor will want the term sheet to be pretty light on details so that once the company is under exclusivity, the investor kind of has the leverage to say, you can't go out and talk to anyone else. And now I'm in a stronger position to negotiate the terms of the deal. So typically, as a founder, you have the most leverage before you sign any exclusivity provision. So before you sign that exclusivity provision, negotiating hard to see all the terms that are favorable to you that you want in the term sheet, that's when you're going to have the most leverage to do it. And so that is the conclusion of what we've prepared for this meeting. And so now, any other questions, certainly welcome.
So, quick question. We were talking about the independent board members. What about advisors? How are they usually compensated, and which types of documents should they sign?
Great question. So an advisor, similar to what I was saying, an observer doesn't have any duties to the company. An advisor doesn't either. And so to the extent that you're bringing on an advisor, you typically want them to have a lot of the same protecting provisions that protect the company as you would have with an employee. Namely, you want them to be subject to confidentiality, and you want an agreement from them that any IP or ideas that they create belong to the company, not to them. So you typically have them sign up to an agreement that would have confidentiality and assignment of invention provisions in it. And then advisors usually do get some form of compensation. In an early stage company, again, it's almost never cash. It's almost always equity. And you see pretty similar terms for that equity as you see for directors, which is something like a very small percentage of the company, like, it could be 0.1, 0.2% of the company, but depending on what they're doing. And it will usually be subject to vesting. And for advisors, a lot of times it's subject to vesting, including having performance criteria. So your agreement with the advisor will say, here are the things you need to do for your equity to continue to vest. You need to be available for an hour-long discussion once a quarter. You need to attend board meetings if requested to do so in an observer capacity. You need to be on call for X, Y, and Z. Basically, setting out the rules of the road to make sure that they're actually providing value. Because again, you'll be spending a scarce resource, which is your equity, to bring in that advisor, and you want to make sure that they're actually providing value.
And Cecilia has a question.
Hi, thanks so much for this. And sorry if I missed this earlier, but on the topic of vesting, is there a standard vesting schedule or agreement that you think early stage joiners should look for?
It's a great question. So there is an industry standard, and that industry standard is vesting over 4 years with a cliff after 1 year. So what that means is for the first year, no vesting. Then on the 1 year anniversary, 25% vesting, and then equal vesting tranches for the next 3 years, either on a monthly or quarterly basis. That's the industry standard. That can be sliced and diced in a million different ways. So I have seen companies that have a 5 year vesting period. That's pretty uncommon. Or that have a shorter vesting period, but 4 years with a 1 year cliff is kind of just like what you'll see in the very large majority of cases.
All right, well, I don't see any other questions, and I think we are about at time. So I just want to say thank you so much, Matt, for doing this today. As some of you might know, Matt's actually one of our entrepreneurs in residence. And so if you do have any other questions, we're going to be posting these slides. But in the fall, once we start our entrepreneurs in residence program, you can meet with Matt one-on-one. So thanks again, Matt, and have a great rest of your day.
Thank you. I want to thank everyone who joined today. I wish you all great luck in your ventures. I hope you have a great rest of the summer.